In the past 40 years, the S&P 500 has experienced around 5 major market crashes. But what strategy of investing saw the highest return for investors? Hey everyone, and welcome to The Savvy Squaddy. In this video, I'm going to explain to you why time in the market beats timing the market. Now, this video is heavily inspired by this Reddit post. This guy has done all the math, and I will link the post and his calculation spreadsheet in the description below. To help illustrate this example, we'll use the S&P 500 and use the period from 1980 to 2020 as we have all the historical data for this. During this time, there were 5 market crashes that happened. Black Monday at the tail end of 1987, where the S&P 500 dropped around 33%. Then the Gulf War, which saw a 20% drop in 1990 over a few months, a 49% drop between 2000 and 2002 during the dot-com crash, then the financial crisis between 2007 and 2009, which saw a 56% drop in the S&P 500, and then finally the crash that occurred during the plague in 2020, which saw a 34% drop in just 1 month. All those emotional investors cashing in to buy toilet roll, the bloody plebs. So our victims are Joe, Jane and John. They all decide they're going to start investing into the S&P 500 in mid-1980, and they continue to do so for around 40 years until mid-2020. They all end up investing £96,000 each over that period, but they all use a different strategy. So who will come out on top? Well, first up is Joe, and he thinks he's got it all figured out. He puts £200 into a savings account every month with an annual return of 3%. He then invests that lump sum he has built up over that time at the worst possible moment, albeit he doesn't realise that until after the fact. He invests at the highest point the market is at, just before it then begins to crash. Joe has the worst market timing of the 3. Once he buys in at the top, he then begins to save again, ready for his next buy-in, which also happens to be at the top. And he continues this spell of bad market timing for all 5 crashes. Now, Joe does not allow his emotions to control his investment decisions. Even though he invested at the worst possible time, he never sold, even when he was seeing his portfolio go down by thousands of pounds. You might think because of his poor market timing that he would be skint. You would, however, be wrong. After those 40 years, midway through 2020, he still ended up with his positions being worth £700,708 after a total investment of £96,000 of his own money. Not bad for someone with shit timing. Next up is Jane, and she is the opposite of Joe. She is the master at timing the markets. Jane uses the exact same strategy as Joe, but when she buys into the market, she times it perfectly with the bottom of each of those 5 crashes, and not the top like Joe. She buys in at the lowest possible price and therefore earns the maximum returns when the market bounces back. So naturally you would expect her returns to be much more than Joe's, and you'd be right. After investing £96,000 of her own money over those 40 years, her portfolio ended up being worth £1,024,277. That is around 46% more than Joe's portfolio. Not too shabby. We then come to John. Now, John's strategy is considered boring by Joe and Jane. His investing method is to simply buy £200 of the S&P 500 index fund each and every month for the 40 years. He does not save the money waiting to time the market. He just consistently and regularly invests each and every month. He buys at the highs, he buys at the lows, and everywhere in between. He has it set up as an automatic deposit to come out on the 1st of every month. John just sets it and forgets it. This is known as pound cost averaging, or dollar cost averaging depending on who you watch and their target audience. Essentially just insert local currency here. Now, how might you think John's performance compares to Joe and Jane? Perhaps it's better than Joe and his terrible timing. I mean, that kind of makes sense. But could it be better than Jane and her perfect timing? Well, after investing his £96,000 over 40 years, John would end up with £1,371,996. That is very nearly 34% more than Jane, who timed the market perfectly, and 95% more than Joe, who had the shittest market timing. John beat the other 2 and with the least effort as well. If you try and time the market, you need to be monitoring every aspect of the economy so closely each and every day to have any form of success. you would have to spend hours upon hours each week analysing tons of data to try and find the right moment to drop your money into the market, and even then, you aren't guaranteed to make a fat profit. Why waste all that time when you could just set it and forget it? There are of course people who dedicate their lives to trying to time the market, and some of these people can be successful and earn a profit either for themselves or for their investors. But for the everyday person, it's not a viable or sensible investment strategy, and I would argue that there are much better things to be focusing that time on that would give you a better return on investment than trying to time the market. Joe and Jane are anomalies for the purpose of the example. Most people who try and time the market wouldn't hold their money in the market for that long. They would then sell when they think the time is right at a high point to lock in those gains and then do it all again. These people are known as traders. They trade in and out of the stock market often. They could buy and sell with only a few minutes in between. Trading is more akin to gambling rather than actual investing. Trying to time the market is like trying to catch a falling knife. It might work out, but more often than not you'll end up getting hurt. In contrast, buying and holding is like planting a tree. It might take a while to see the fruits of your labour, but once it starts bearing fruit, it will continue to do so for years to come. Have a think about this. If timing the market really worked and drawing lines on a stock chart somehow predicted the high and low points of the market, then where the f*** are all the quadrillionaires? Where are all the people rich beyond belief from using this clearly very sound investment strategy? The stock market is an unpredictable and volatile place over the short term, and trying to time the market is just another form of gambling. It's not investing. The reason John did the best was because it is time in the market that counts, not timing the market. Joe and Jane kept their money on the sidelines waiting for the perfect opportunity, and during that time where their money was not invested, they were missing all the ups and downs that the stock market goes through day to day and month to month, while John was buying in every month and benefiting much more from the compounding effect over the other two. The idea that people can time the market and consistently make profitable investments is utter bullshit. While some of these people may experience occasional success in timing the market, in the long run, attempting to time the market is generally not a reliable or effective investment strategy, and we've now seen that by the worked example I've just gone through. For the everyday person, buy and hold, set it and forget it, is the easiest, safest, cheapest, most time efficient and profitable investment strategy out there. Hopefully this video has helped demonstrate that. If you want to learn more about investing and the power of compound interest, then check out some of my other videos here on the channel. I'll link them below. Are you a buy and hold investor, or are you more akin to a gambler? Let me know in the comments below. Thank you all for watching. If you liked what you just saw, please hit the subscribe button up there, and if you want to see some more videos, click over there. See you soon.